I am excited to introduce the next panel here with Latham and Watkins, and they're going to talk about key strategies to accelerating your growth. So please welcome our next panel.
All right. Is this thing working? It is. We'll test it. So first thing I want to do is wish my wife, who's on the other side of the continent. You want me to first? First thing, you're good. First thing I want to do is wish my wife a happy birthday. She is hiking in Costa Rica right now, which may not be the worst place in the world to be. So that's where she is right now. I love you. I wish you a very happy birthday. I look forward to seeing you when you get home safe. Let's do some introductions here. Thank you all for being here. My name is Michael Benjamin. I'm a corporate partner at the law firm of Latham and Watkins. I head up our consumer retail coverage, so I spend a lot of time with players in the consumer retail ecosystem, whether it's investors, operators, financing sources, and the like. I think this is my fourth or fifth conference. They're always super impactful and interesting, and it's lovely to be here with you. I think first thing we'll do is just run quickly down the panel here so everyone can introduce themselves, and then we're going to talk about money.
Brian Patterson. I'm also a partner at Latham & Watkins, although I just met Michael, 3 months ago maybe? But I'm the global vice chair of emerging companies and growth, which is basically our startup and VC practice.
I'm Allison Beller. I'm a partner at Prelude Growth, which is a New York-based, female-founded consumer growth equity firm, and we partner with the leading high-growth consumer brands of the future.
And I'll round it out. Hey everyone, Marlon Nichols, co-founder and managing partner of Mac Venture Capital. Mac is a seed stage venture firm based here in LA. We invest throughout North America and do some emerging markets as well. Across 3 funds, we manage about $600 million, and happy to be here.
Just closed a new fund.
We just closed a new fund.
Congratulations. It's actually a good segue. So we, as I said, we're here to talk about money. We've got people on stage who have it. We've got people in the audience who want it. And we should talk about how the dynamics change. Maybe I'll start the discussion, and I want to hear from everyone on all of these questions. 2020, 2021, go-go days, money's flowing everywhere, checkbooks are open. It's a very different environment now. We've got a robust economy. All indicators seem to show the consumer is in a good place and willing to spend money on things that they want. What are the biggest differences between sort of 3 or 4 years ago and now in terms of what investors are looking for?
You guys are the investors.
Yeah, okay, I can start. So look, Michael's right. 2021 was the glory days of private equity and venture capital investing. We've never seen so much deal activity. And if you look today in 2024, overall private equity deal activity is down 25%. So you're definitely seeing a slowing of investing pace. You're also seeing valuations start to come down. And I think what's driving that is a few things. One, you're seeing rising interest rates or higher interest rates. So obviously higher interest rates are going to lead to some valuation crunch. You're also seeing a more challenging fundraising environment. So congrats on getting that fund raised, but you are seeing LPs who've shifted a lot of their investments into alternatives and haven't seen as much capital returned. So they're starting to put the brakes on giving more money to venture capital and more money to private equity, waiting to kind of get some money back. And then lastly, you are, the consumer has been strong, but for a while now, we're sort of wondering when the consumer takes his foot off of the gas. Every month we look at what's happening, and you continue to see strong consumer spending, but overall there's anticipation of some slowdown, and I think what that's leading to is a fear that you might make the wrong investment, that you might partner with a brand that can't weather the storm. I think what's important in that environment is a few things. One, I think we'll talk about later, but one is I think you're seeing a shift from a focus on growth to a shift towards profitability. So a real focus on business fundamentals. And 2 is partnering with businesses that are focused on long-term trends that are going to be, long-term, decade-long trends that you can invest behind rather than fads. So 3 trends that we're really focused on at Prelude. One is diversity. You're seeing Hispanic, Asian, and Black populations increasing as a percent of the overall US population. And so that's leading to increases in things like ethnic food, beauty that's formulated for a more diverse consumer base, and just broad diversity. So that's one trend that we're investing behind. The second is increasing focus on health and wellness. That means more brands that are better for you, but also sustainable. And then the last is sort of the barbell economy or the hourglass economy, where you're seeing increases in higher income brackets and lower income brackets and sort of a decline in the middle. One thing that I think is particularly interesting, though, is since 2019, real income has grown the most for the lowest income population, right? We're all hearing about it, minimum wage increases. And so the people with more dollars in their wallets post-COVID is actually lower income consumers. And so while I think most brands here are probably focused on premium and mass are going faster than everything in the middle. So Lululemon, LVMH growing in the teens, but you have Shein growing at 80% CAGR since 2019. So brands that are figuring out ways to bring value to the consumers and really high value mass products, I think is another really interesting place that we're looking to find great investments.
Marlon?
Yeah, I'll say it in a different way. When you give shit away for free, it causes bad habits. And the cost of capital was basically zero in 2021, 2022. And that led to LPs, my investors, being able to write checks more frequently. And so what that led folks like me, not us, but other folks like me,
all the other guys.
Yeah, the other guys, to basically deploy money as quickly as possible so they can come back and get more, right? And that money was readily available. Now, what that meant for startups is that they would need to find uses for that money. And basically that use was growth, and growth at all costs, right? So, but now that the cost of capital actually, or capital actually costs something, that pool of money has dried up. And so now we're being much more selective with the investments that we make. And growth is still important, but profitable growth is what we're looking for, right? We want to see companies that don't need to keep coming back to the well in order to fuel their business.
Marlon, can I pick up on that? Because one of the big differences that I experienced, I spent a lot of time in the later stages. Brian works with companies in the earlier stage, and then we sort of meet in the middle, and I like to ring the bell on the stock exchange to help my delicate ego. I enjoy that very much. But it was growth. And people really didn't focus on profit. It's like, oh, we'll get there. Even, there's a lot of people in this room today on the operating side who are early stage and who are figuring out their business plans. How would what would both of you as investors advise them in terms of balancing growth and profitability, even at an early stage?
I think, yeah, so we're the seed investors, so I'll go first. We're not going to expect a seed stage company, even a Series A company, to be profitable. Although we are seeing some that bottom line profitable, right, net profit. But what we are looking for are great unit economics, right? So unit economics that show that there is a path to profitability and you can get there fairly quickly. And that's the name of the game now. And if you as seed stage investor, as we're evaluating companies, we're looking at what the next round of investors are going to be looking for in our companies, right? And that's basically 2x growth, 1.5, what do you call it? Basically growth to debt or expense multiple, right? Anything below that, they're not going to touch it. They also want to see, that on the capital that they're raising, that they can operate the company for at least 24 months, right, without coming back to the well. And there are very specific targets that they're going to set for these companies to meet before, parting with the wallet.
So you're very empirical about it. It's going to be data driven. You want people to hit certain metrics. You want to see that discipline even at the seed and A stage.
Yeah.
Allison?
Yeah, I agree with that. I think it's not necessary for businesses as they're scaling to have EBITDA profitability, but if your gross margin or contribution margin isn't sufficient to sustain the business through different economic conditions, that you're not going to grow your way out of that problem. If every marginal unit you sell, you're losing money on, you don't want to sell more units. So, when we look at our portfolio at Prelude, we have an average gross margin across our businesses of more than 50%. Many of our businesses are, much higher than that, yet not all of our brands are EBITDA profitable. And that's great news for us, because we encourage our businesses, once they have the capital from investing partners, to invest in the business, to spend more money on A-plus management teams, to spend the incremental marketing dollars if they have really strong ROAS. It's not necessary for the business to be profitable, and if those businesses need more capital from their investors over time, we're happy to put more money in, but at the unit economic level, there has to be really, really strong profitability and a continued focus on improving margins year in, year out. So always laser focused on what can we do to continue to provide the right product to our customers, so never sacrificing on product quality. You have to stay true to your business, but improving those margins in ways that you can.
One other quick point. If you think about, you're always looking ahead to the liquidity event, right? And that's either an IPO, which is rare, or it's an M&A, which is less rare. Well, in this market, it's kind of rare. It's starting to come back around. And the new buzzword or buzz term is Rule of 40. Have you guys heard that? So basically, between your growth multiple and your EBITDA, you got to be 40%, right? So you don't have to be profitable, but you got to be near it. And for whatever you're lacking in profitability, you have to be making up in growth. But the two things have to work together to get to 40%.
Interesting. Brian, I want to ask you a question, because you sit at the intersection of negotiations between investors and companies and founders and operators and whatnot. What would you recommend to people in this room who are considering raising capital, whether it's seed or later stage? What are the top 3 or 4 things that you would suggest they focus on to get prepared?
Yeah, it's a great question. So obviously, great advice nuggets here. That's going to be critical. That's key. There is no conversation without hitting those pieces. But I'd say, if I hit on a legal point, it'll be around IP ownership. That would be a key one. So make sure your house is in order from that perspective. We've got a lot of consumer brands here. Trademarks are important. Obviously, if you've got a hard product, patents could be very important as well. Less so in software businesses usually, but I would just make sure, just generally, if you have a vendor out there that helped you build your product, you've got development personnel, et cetera, make sure that they all have contracts in place, agreements, everything's tight, because that's a sure way to kind of create a diligence issue as far as your fundraise goes. I would also just say, be really thoughtful about how you run your fundraising process. There's lots of different ways. There's lots written on the internet about how to go about this as far as scheduling, but be strategic about it, because I find a lot of companies will go out and they'll just sort of, okay, it's time to fundraise. Let me get my spreadsheet. I've got 150 investors listed here. Let me send my blast out and kind of go after all of them, versus being very strategic about it and thinking about, does this particular firm actually match my company? Have they made similar investments in the past? Do they have a conflicting investment? It's really important to sort of think that through, because I think that'll make your process much more efficient. Use your advisors, use your network for introductions, et cetera. But those are probably two things that kind of come to mind.
I want to ask all 3 of you this, because you're going to have different perspectives. Red flags. If Brian, a new client, comes to you and says, Marlon recommended that I speak to you, this is what I'm planning to do in terms of fundraising. A couple of red flags that people should be aware of straight out the gate.
Yeah. So I think from a red flag standpoint, this is probably something you probably all really feel strongly about. Not knowing your core business and your economics of your business. There are a lot of founders out there that they get in front of an investor, and when the hard questions start coming around just kind of layers, a few layers down behind the kind of product and the glitz and everything else that you're kind of showing in a demo, what have you, not understanding your business model, not understanding your competitive landscape, not understanding how you're truly differentiated, I've seen that kind of really cause a big issue in fundraisers.
Allison?
So I'll think of a few. One, I mean, that's a great one. Another, I mean...
But I want to hit on that. So you've been in meetings, Allison. You've been an investor for a long time now. You've been in meetings and you've sat there and you're like, holy shit, this person doesn't understand the unit economics. They don't understand what they're actually selling here.
Yes.
Okay, so I think it's important for the audience to know
Yes.
that these are not fairy tales, that this happens, right?
Yeah, or they just haven't thought about it, right? Like, they're expanding so quickly. They're going into different channels. They're so excited by the growth that they're not stopping to think like, I'm selling on TikTok shops because this is new and it's a great way to try to, sell more product and it's supposed to be so great, but they're not stopping to think about the discounts that's required and the marketing effort that they're putting into it. And when you put all of that together, like, is it profitable for my business? Is this a place that I want to grow? Like, sometimes you see founders who are just excited by the prospect of growth without thinking about what that means for either brand degradation or unit economics. Another thing for me, this is like kind of a red flag, but just what makes a company great, I think, is a clear identified leader who's not afraid to make hard decisions. So when you meet with a team and you've got a founder who's like, oh, I'm not really sure, and, you make a suggestion and they're like, oh, yeah, well, we could do that instead. Like that's obviously collaboration is a good thing, but I don't mind hearing from my founders, like, no, we're not going to do that. That's not who we are. Like, knowing really what your brand is, what it stands for, what you want your business to look like 10, 20 years from now, that's like really attractive, and not knowing that, so not making decisions based on that long-term thinking, I think can be what ultimately makes a good brand go bad.
Marlon?
Sure. Overstating the market opportunity is one. They think it's a much bigger opportunity than it actually is.
Can I just ask you a follow-up on that? Is that because people are sloppy and haven't done their homework, or are they embellishing, or or is it sort of more than
it can be all of the above? Yeah. But
so
it doesn't matter what the reason is.
Yes. Yeah.
Right. It's just that it's happening.
The TAM is 100 billion.
Right. No, it's not. And then not understanding the competitive landscape. Right. So, if I've heard of companies that you haven't heard of, and you're supposed to be competing in this space, that's not good, because I'm actually looking for partners, and what I'm bringing to the table, or what our firm should be bringing to the table, are different strategies that are general to business. You should be bringing domain expertise, right? You should know this space better than anyone sitting on this side of the table. And if you don't, that's problematic. And then I'll answer your question in a different way. Something that we look for in founding teams, it's in three parts. The first is there's got to be someone on a founding team that can sell. And sell in three areas. One, you've got to be able to recruit. No one ever built a great company by themselves. You have to be able to recruit incredible talent. Two, someone's got to have experience selling a product, right? And three, if you're raising venture financing, someone's got to be able to raise money, right? You got to be able to build relationships with investors and raise money, because we're not going to be we can be the first, but we don't want to be your last investor. Right, so that's point one. Point two is that someone on the team needs to have product experience. Right, someone has to understand how to take a thought and turn it into a thing. Right, it's a skill and it's an art. And if that's not on the team, then you're probably not going to get out of the ideation phase, or you're just not going to build a great product.
You're talking about execution. You're talking about building operating infrastructure.
Not even operating infrastructure. I'm talking about the product. Right, so creating a thing, right, that you can then sell. Yeah, and then that's actually the third is if you're building a tech or tech-enabled company, you must have someone on the team that is technical. And earlier in my career, I used to think, well, this is a tech-enabled company. The technology is not that core to what they're building. So sure, they can just outsource who's building that. And yes, you can do that. But if someone that understands the tech and how the engineering works is not sitting inside your organization, you end up spending a lot of money for a lot of shit, right? And so those three things have to be present on any founding team that we invest in.
I want to talk about one of my favorite topics, which is exits, because that's where lawyers can have a lot of fun. So I'm going to be a little self-interested in that. What does the landscape look like for that now? You alluded to it already, Marlon. I can speak to the IPO market, which is not super germane here, but there are real deals being discussed in brands and consumer that, there's maybe the prelude to green shoots. What are we seeing in terms of appetite? Brian, maybe you want to start.
Happy to. So I think, Allison, you mentioned this a little bit earlier. I think the M&A markets definitely, 2024 has not been, a tremendous year for M&A. I think that, especially for strategic M&A, when you're talking about big M&A with the big brands kind of coming in and buying companies, and that's kind of across the board, I would say, in sort of the venture capital space generally. I think that there's some signs and maybe that's starting to change. I'm seeing that a little bit in my own client portfolio where there's some sniffing going around some companies. But I think a lot of these companies actually spent the last year and a half trying to get their own house in order as well. But I think I'm starting to see a little bit of difference is private equity is getting more active. So you're seeing more private equity looking to do roll-ups in certain spaces, certain product lines and things of that nature. So I think that's an area where I would anticipate a little bit more pickup. And then, companies that I would call it later stage private that are well performing, those companies are getting a bit more acquisitive. The ones that have the stronger balance sheets, et cetera, coming in, or stock valuations are coming in and are actually looking to do some M&A at kind of some of these seed companies, A companies, et cetera, that raise capital, and maybe they're having a harder time raising their next round, but actually they have strong viable businesses that might be able to plug in. So if you're in that stage, and sometimes you could kind of look at the kind of 1 + 1 = 3 sort of scenario where maybe there's a private kind of acquisition that takes place, and it could create a company that might have an exit opportunity in the more near term. But I think that's sort of where we sit here today. That's probably the biggest, most active area.
Allison, Marlon, as you answer the question, something else for you to factor in. Do you think that there's discipline around valuation? And when I say discipline, I mean people are grounded in reality about what their businesses are worth when it comes time to exiting.
Buyers or sellers?
But really sellers, to be honest, because I think that's what my personal view is. That's where the logjam is. It's the money's there, but the sellers are like, there's no way that my business is only worth X.
Look, I agree. I think we were coming off, we talked about this a little bit already, everyone was coming off of the post-COVID highs of a zero interest rate environment and a lot of growth, and we're expecting multiples would never change even as interest rates, went from 0 to 6%. And valuations did, as they should, for buyers adjust, and yet sellers weren't ready for that. I think you're starting to see, though, now a realization that there's been a slight reset and that really great brands are finding really great homes. And sometimes that's strategics, although strategics, I think, are being very selective about what assets they're acquiring. It has to be something that they know and that really fits a need in their portfolio. So it's not just, wow, this is a pretty shiny new thing, I'll buy it and see what I can do with it. It's, I have a need in my portfolio for something in a specific category or to attract a specific customer, and so I'm going to find the asset that fills that need. So knowing where you would fit well and whether you solve someone's need, I think, is important. And then also, private equity is is coming back, and I think private equity stayed away from consumer for a little while. There were there was interest in what I'll call like more services roll-ups in the private equity space, but general consumer brands, private equity stayed away from, and I think you're starting to see reinvestment in those areas. You know, we had a brand, a beauty brand called Summer Fridays that we exited over the summer, and we spoke to a lot of strategics, and ultimately it was TSG, a private equity firm, who was the most enthusiastic buyer of the business. So, you know, there can be great outcomes either way.
Marlon?
Yeah, I think the top two reasons for M&A's failures is one, valuation like divide, right? The buyer and the seller can't agree on the price. And then the second one is the performance of the asset significantly decreases during the negotiation period. The only thing, you guys said most of it, the only thing I'll add is that acquirers today, they're not looking to have drains on their balance sheet. So they're not interested in buying anything that's not profitable. So that's it.
So it's got to be turnkey. If you're going to continue to go it alone, and we've only got a few minutes left here, so this will probably be the wrap-up question. If you're going to go it alone, how do you think about recaps, down rounds? You know, there's sort of people are incredibly averse to them, and for understandable reasons, because usually investor documents are punitive on that. But if it becomes a matter of survival, obviously it's worthy of consideration. But just more almost from an emotional perspective, how do you feel about recaps and down rounds?
Why don't I do clean up on this one and then you guys can go, because I'm curious
Marlon?
what you might say.
Sure. Yeah. In this environment, down rounds are like flat rounds, and flat rounds are like up rounds. Because, like you said, there's being a reset right now. They're just necessary. When I was starting in this business, one of my mentors told me, and this is actually very true, the only two valuations that matter are the one when you get into the investment and one when you get out, right? You can have something that looks like this as long as it ends like this, right? So we think about that. From the investor seat, though, we have to think about whether or not it makes sense for us to participate in said down round. And in the back of my mind is like, where is this thing going to end up at the end? Is it going to be there, or is it going to be there, right? And that's what we try to understand. And if it is, then we'll participate. If it is, a lot of upside.
Yeah, I agree with everything you said. For us, I think, as a founder, I think a down round is hard, right? That's hard to stomach. But the question is it performance in the business, or is it things that are out of your control? And I think today, there's a lot of things out of your control that are just driving that environment. So not making it about ego, not making it, a commentary on the business itself and how you've performed, but understanding that macro conditions can change and this is what's best for the company, I think is the advice I would have to founders. And then as an investor, when you see one of your businesses underperform, the question is like, are you still in it? And if you're in it, then great. This is an opportunity to put more money in at a lower valuation and let's go. And if you're not in it, then, you're probably not the right partner for the company to see its way to the future. And that's okay too. Not everything in the portfolio is going to perform perfectly. You have to allow some room for losses. We don't, obviously, because that doesn't happen. But
no
I think
losses on our balance sheet.
Right? No. But I think it's like a really honest conversation with yourself and with the founder as to whether is now the time that you're really the right partner to continue on this journey. And if you are, then you put the money in, and if you're not, then you understand and you sort of, let someone else take the reins.
You know what always trumps ego? Survival. Right? And if you got to take that down round to survive, guess what? You're going to take it. The one other point I hand over to Brian is basically dilution is probably the biggest concern for a founder when you're thinking about the down round, right? It's not necessarily the actual number, right? It's how much of the company am I giving or selling? And then what does that mean for me at the end of this? Like, is this still worth the time that I'm putting into it, right? But there are remedies for that. Once the company starts performing well, your next round of investment, you can get equity top-ups and things like that. So it's not the end of the world. Like, literally think about what's best for the business.
Completely agree. All well stated. The one thing, I guess, a couple of points I would say really quickly is when you take initial investment, this is one of the key areas to really focus on, asking that question of, how do you actually work with your startups when things aren't going quite as well, what's your percentage of follow-on checks? Those kinds of questions, I think, are really key questions. A lot of founders don't ask those up front when they're selecting an investor. So at times like these, when you're talking about down rounds, it's super important. And then, I just kind of echo what everyone's saying. The down rounds, they're kind of part of the nature, of course, of a lot of startups, especially now. A lot of folks, despite what your friends may say when they all go to the bar, they say that everybody's crushing it and doing really well and getting along with their investors and all that. A lot of you are going through the same kinds of trials and tribulations. It just kind of comes with the territory. So it is about that exit value. And so I've seen a number of companies go through periods where they raise down rounds at some point in their life cycle. And then, 2, 3, 4 years down the line, they've recouped that value and some, and they're kind of off to the races building a nice new business with another set of investors, oftentimes that are more conducive to the business. So, I wouldn't wear it as sort of a scarlet letter by any means.
Super expansive discussion. Thank you, Marlon, Allison, and Brian. Thank you for having us.